Hi everyone, welcome. We will be starting this webinar shortly when we have a bit more joiners.
Why don't we begin? It's about three after the hour, and so I want to reward those of you who dialed in early. Welcome, everyone, and thank you so much for joining us today. My name is Annette Nazareth, and I'm chair of the governing board of the Integrity Council for the Voluntary Carbon Market. It's a real pleasure to convene this discussion today and to bring together such a thoughtful group of speakers who are actively shaping the future of the carbon markets. Today's webinar is the first in what we hope will become a regular series over the coming year. Through these sessions, the Integrity Council will share insights from our continuous improvement work programs, which we call the CIWPs. These programs bring together leading market experts and key stakeholders in a collaborative effort to tackle some of the most complex challenges facing the market. They help shape the next generation of high integrity solutions and identify opportunities to raise ambition across the board. Today's session is grounded in the recently published CIWP report on market transparency, scalability, and standardization. At its core, the work program addressed the critical idea of how to ensure that high-integrity carbon credits can function as credible, investable assets at scale. As many of you know, the Integrity Council established our core carbon principles, known as the CCPs, as the global quality threshold for carbon credits. But the CCPs were never intended to solve everything. They ensure credit level integrity, but for markets to scale, we need the systems around those credits to work effectively. The purpose of this work was to identify the gaps and frictions in the market that limit scale and trust, to clarify where the Integrity Council should provide further guidance or requirements, and importantly, where other actors, governments, infrastructure providers, financial institutions must lead. This is not about the Integrity Council designing the market. It's about helping ensure the conditions exist for a high integrity market to function and to grow. Carbon markets have a critical role to play in mobilizing private finance for climate action. But historically, as we all know, they have faced challenges: limited transparency, fragmented infrastructure, and a lack of alignment with capital market norms. These issues ultimately affect trust, liquidity, and the ability to attract long-term institutional capital. This work program was designed to address these foundational issues head-on. The work focused on three interconnected pillars. First, market infrastructure, including registries, interoperability, and ownership clarity. Second, pricing transparency and integrity, including visibility of pricing, fees, and benefit sharing. And third, catalyzing structured finance, including auditability, risk frameworks, and financial integration. Together, these are the building blocks of a market that can scale with integrity, not at the expense of it, and no single actor, as we know, can solve these challenges alone. With that, I'm very pleased to introduce today's panel, who all contributed enormously to delivering this report as co-chairs of our working group, and who each bring deep expertise across registry, infrastructure, finance, and carbon markets. We'll be exploring how these recommendations translate into real-world action and what it will take to move from frameworks to functioning markets. Thank you again for joining us, and I look forward to this discussion. And with that, I will virtually pass the floor to Kavita, who will moderate our discussion. Thank you.
Thank you so much, Annette. It's such a pleasure to be here with all of you, and it's great to see how many people are interested in this topic of market transparency, scalability, and standardization. Uh, Annette, you've been not only the chair of the ICVCM, but also been very closely involved with this continuous work program. So, we may have you as our expert on the panel as well. But let me first introduce myself. My name is Kavita Prakashmani. I am a board member of the Integrity Council, and I am the founder of Dragonfly Advisory, which works on climate issues, especially nature-based climate solutions, and sustainable agriculture. I had the privilege of co-chairing one of the subgroups under the CIWP with Basak, and so feel like we have come a full circle to have this absolutely fantastic report, which is enabling us to have this discussion on how the market needs to be structured around high integrity and high quality carbon credits. We have an exceptional group of leaders here with us today for our panel. They have been the leads of the three subgroups within the CIWP, focusing on the areas that Annette mentioned, but I will do so here again. But let me first introduce our panel. We have Chris Canavan, who is the CEO of the Global Carbon Market Utility. We have Andrea Abrahams, who is the Managing Director of the Voluntary Carbon Market at IETA. And we have Basak Udemis, who is the global lead for carbon finance at the International Finance Corporation. We could not have asked for better expertise. The three subgroups that each of them led collectively help us frame the topic of transparency and scalability standardization of markets. The first one, led by Chris, was around market infrastructure, which is really seeing how we, even if we do get high integrity credits, which is what the CCPs and ICVCM is about, how does the market actually work? What are the registries? What is the interoperability? And what is the underlying architecture of the market that we need to sustain? The second, led by Andrea, is on pricing transparency and integrity, which is really about transparency and disclosure for benefit and revenue sharing, for fee structures around the market, and for fairness. We know that there's a number of players who are involved in bringing carbon credits to the market, from communities and indigenous peoples right up to the buyers. And so how do we make sure that there is transparency in the entire process? And the third one, led by Basak, was on catalyzing structured finance, which is really about how do we bring more capital into the carbon market, into these projects and programs. And so it's focused on unlocking institutional capital through improved risk, auditability, and financial frameworks. What can we learn and adopt from the financial market that will help us scale the carbon market? So each of these groups obviously spent a lot of time first defining. As you can imagine, this is a very vast topic. So, defining the scope of the challenges under each of these, but then starting to define practical pathways forward. And Annette said that these are not pathways that necessarily ICVCM will be taking forward, but we do hope that a whole range of stakeholders who are core and leading in this market infrastructure will step up and enable a higher integrity market. With that, I'm going to let our co-chairs of the three work streams talk about the work that they've done and what we found. And I will turn to them to say, how did you define the scope of the problem in your respective areas, which we know is vast and difficult in itself? And then how did you begin to tackle these challenges through the work program? So the scope and how you tackled it. So maybe, Chris, I will start with you.
Thank you, Kavita, and thank you, Annette, and thank you to ICVCM for first including me in this, together with my co-chair, Pedro Barata, who should be cited as well. We had a difficult task of harnessing all of and synthesizing the experience and the wisdom of those who are on our panel. And we began precisely with a scoping challenge, which was to decide within this broad area of market infrastructure, what we thought the most important priorities would be. And I think that in keeping with what is the true power of ICVCM, namely its power to convene and its commitment to a very consultative process, we wanted to harness both of those, that convening power and that power of consultation, to identify those priorities. We had identified a list of priorities, I think, and then ranked them. And I think that most in the group were rather surprised that both the list and the ranking perhaps wasn't exactly what they would have expected. As you can see in the report, the priorities were regulation, ownership, transparency, which of course was covered elsewhere, convergence, interoperability, resilience, and incentive alignment, not necessarily in that order. Our approach was to consider each one of those priorities in order of priority, but always return to, I think, what for us were the touchstone questions, which were, what recommendations can we make that address these issues but drive systemic change? As Annette said, the ICVCM is not only doing all of the good work it does, applying the assessment framework and attaching CCP labels to programs and methodologies, is all thinking about much broader system level issues. And so that's what we really wanted to focus on. What is it that we can recommend that we think drives the systemic change that the market needs in order to scale, in order to deliver the trust and the liquidity and the depth that it needs? So I think that's how we both scoped and approached this. We scoped it by consulting with the working group members to identify the priorities and rank them. And then we dug into each one of them, asking ourselves over and over again, how does this aspect need to change in order to drive systemic change?
Thank you, Chris. I'm sure we have lots of questions, and just a reminder to everyone online to please use the Q&A function, which you will see in your options at the bottom, to please send us your questions, and we're trying to keep substantive time for Q&A. Thanks, Chris. Let me move to Andrea. Andrea, huge concerns about transparency and disclosure. So how would you scope that and approach it?
Yeah, thanks, Kavita. And thanks, Annette, for leading the overall work stream. It was really a privilege to be involved in this work, and I could only concur that in the actual working groups, we had such a fantastic representation of the market joining each of those groups. And I hope some of them are actually on the call and can, put in some questions and contribute to the discussion. But it's as you say, it's a broad subject, and where we think about pricing transparency and integrity, what we were quite disciplined in doing is coming back to the fact that we're talking about those two subjects relative to scale in the market. You can talk about pricing transparency from many perspectives. You can talk about integrity from a multitude of perspectives, but it's all relative to scale in the market. And that was important because in some parts of our discussion, we realized we were drifting away from that and overlapping with other CIWP discussions, in particular when it came to benefit sharing. We kept sort of pulling ourselves back and saying, no, we're thinking about it through the lens of scale in the market. So when you read the report and you look at the recommendations from 7.2 subgroup, it's always with that in mind. So transparency, integrity in of themselves are not the subject, but relative to how we build trust in the market and scale the market. So that was the sort of scoping exercise. In terms of approach, something we kept reminding the working group that the question on the table is an open question. It's an open question of, does the market need to do anything to improve integrity, improve pricing models in order to scale? the fact that the question is being asked does not presuppose the answer. And I think that was really important because initially some people were saying, yeah, but there's no problem with this. No, we're not saying there's a problem. It's a question of whether there's something that needs to be addressed so that the next iteration of the assessment framework can be more finely tuned. The other thing in terms of the approach is that it really was grounded in practical knowledge. The people in the working group are practitioners in the market, including from communities involved in implementing projects and negotiating projects, to project developers, to crediting programs, to lawyers. So people are talking very much from their first-hand experience, and that was incredibly valuable. I think then in terms of also getting back to what Chris was saying, in terms of the recommendations, we also thought very hard about things that were implementable. So a number of times concerns came in that we should be cautious not to overcomplicate. It wasn't change for change's sake or recommendations for recommendation's sake. These need to be implementable actions because they are relevant and important. So that's what we tried to focus on. We came up with 5 actionable recommendations. You can read them on page 28 and page 30. So they're quite short and punchy. And perhaps the other thing to just remind everyone, in the report, especially in the appendix, you will see a longer list. And that's because we were, as far as our brief was concerned, it was not to only look at recommendations that the ICVCM should take and own, but also recommendations that the market, others in the market should take and own. So the brief was wider than only things that the CCP could implement in future, or sorry, the assessment framework could implement.
Thank you, Andrea. We'll get into a bit more detail because I know this is close to very many people's heart in how the money flows. But I'll move to Basar. Basar, it was a pleasure to co-chair that with you. And I think I learned way more than I thought I would through the discussion. But let me turn to you in terms of how we scoped it, but also the approach, because after all, the main thing is to get money into the market.
Thank you, Kavita, and I would like to thank also all the members of the working group and ICVCM team, who both have been phenomenal, I must say. It has been a pleasure for me, and like you, I learned more than I thought actually throughout the process. On our section, we really tried to view the market through an investor lens. The starting point was kind of a deliberate choice to step back from the carbon market's internal logic, like project methodologies, verification cycles, registries, but ask a more kind of fundamental question: why does the institutional capital still treat this market as uninvestable despite years of development? That was kind of our main question. And we found the answer lies in 3 kind of compounding barriers. The first one is the risk profiles are unclear. So we focused on that. The carbon credits do not map cleanly onto existing asset classifications, which means like the general investors cannot apply standard credit risk and market risk frameworks to them. So without a recognized risk profile, due diligence, as we all know, becomes prohibitively bespoke and expensive. So that was one of the main barriers. And we try to, focus on that on the scope. The second was the standardization is insufficient. The pricing, the contract terms, the quality definitions, like disclosure formats, like many, vary across the registries, methodologies, and this kind of fragmentation prevents the comparability that the institutional investors depend on for kind of portfolio construction and benchmarking. And third one was the auditability is inadequate. The financial markets operates on the assumption of finance grade assurance. So there must be an independently verified, consistently kind of formatted data that can support the balance sheet treatment and regulatory reporting. The voluntary carbon market does not meet that bar yet. which means the investors kind of lack the trusted informational foundation they need to price and finance credits at scale. And those are kind of like our lens, like those formed our lens of kind of looking at things. As an approach, we kind of took the premise that the voluntary carbon market will not attract institutional capital by asking investors to adapt to it. So the market itself needs to adapt to the norms and infrastructure of the financial market. So that means the work focused on three areas based on the scope that I kind of mentioned: the structures, the risk frameworks, and use cases. So on structures, we focused on kind of what are the financial instruments that are closest to deployment and what specific kind of enabling conditions each requires. So be it blended finance, forward contracting, securitization, they each have a role, but they require different preconditions and are appropriate for different stages of the market maturity. So this mapping, this sequencing is critical to avoid kind of pursuing instruments that are technically elegant, but practically would be practically premature for the market. And on risk frameworks, again, our approach was advocating for standardized cross-market definitions of risk, covering project-level risk, such as non-delivery, reversal, as well as market-level risks, such as the price volatility, regulatory change, and so on. So without the common language, risk language, the institutional investors cannot build on internal approval frameworks, which are kind of hard organizational barrier, regardless of the investment appetite. And finally, we focused on the use cases. The work focused on demonstrating concrete, kind of replicable transactions that the institutional investors can reference, because we know the abstract kind of arguments about the market potential may not move investment committees, but if we can document kind of credible precedents that can be impactful for the investment committees. So identifying and structuring those use cases, even maybe at modest at initial scale, it was essential to building the track record to unlock the larger flows of capital. So that was a kind of our perspective and our kind of approach and scope. It's really focusing on what the institutional capital need and to look at the market from a strict investor lens. Thank you.
And there was so much we could learn. Thank you. There's such a depth of knowledge here and so many things to pick up. But again, I'll encourage everyone in our participants to put their questions in Q&A, but take the privilege to do a second round of questions with our experts here to just get into a little more depth around some of the topics. So, Chris, I'm going to put you on the spot, and I know this is a tough one, but what would you pick as the biggest point of friction today in market infrastructure? What's that one issue that would unlock scale?
I always am frustrated by the question if you had to choose one thing. And so what I will choose is the permission to perhaps choose two things rather than one. We focused on 6 issues. I mentioned them very quickly, but regulation, ownership, legal title, et cetera, transparency, interoperability, resilience, and then incentive alignment. And if I had to choose 1/2 of those that require effort, but collective effort, I think in order to improve the quality of infrastructure, both hard infrastructure and what I sometimes call soft infrastructure, protocols, conventions, standards, and the rest, I think I would choose, but I speak only for myself, efforts to improve incentive alignment and efforts to improve the legal underpinnings of carbon credits. The incentive alignment arose in our conversations because we know that one of the reasons trust has been hard to gain in this market is the perception and in some cases, it's only a perception that there are conflicts of interest. And these conflicts of interest, if they do exist, arise in the minds of those who worry about it, either because there is a conflation of functions. Functions are not independent enough, and or there is a lack of governance or proper governance over, for example, third-party assurance and the like. And if we could really work hard on those, on that, then I think that would go a long way towards establishing the kind of trust we know this market needs. And on legal title, and as I hinted at earlier, the list of priorities and the ranking of priorities, I think, surprised most in the group, and legal title rose very close to the top. I think that there is a general recognition that unless the legal underpinnings, the legal nature of carbon credits is more firmly established across the market, it will be very difficult to do, for example, what Basak was referring to map onto this market all of the standard mechanisms and instruments and transactions and structures that are familiar in other markets, especially with respect to project finance. But also, legal underpinnings are necessary for any robust auditable regime, right? The first question any auditor asks is it an asset or not? And if it is, who owns it? Which balance sheet does it belong on? But the other reason I think I would choose those two out of the six, and the list could be much longer, is that if we could make good progress on both incentive alignment and legal underpinnings, I think that would help shape the other priorities. It would help push better regulation, better transparency, better interoperability, and even greater resilience. And also because those two are really public goods, right? If we can get a system level regime in place where people feel confident that there is sufficient functional independence across the market and proper governance, then that's a public good that helps scale the market. And the same is true for legal title. We know that there are many efforts, both within actors in this market and in bodies like UNIDROIT, trying to address these. And so we didn't come up with these as if no one else had thought about them, and we encourage and support and champion other efforts to address these. But I think those would be the two that I would choose.
Thank you, Chris. Yes, and you can choose to. But before I move on to Andre and Basak, I just had a follow-up question. Like, do you feel like, or did the group feel like there was a trade-off between innovation and standardization? It always feels like we're, trying new things, but we also need interoperability, we need standardization, we need, the legal underpinning. Is there a trade-off?
I again will speak for the group with caution, and if there are group members on, please correct me. No, I think in fact it works the other way around. I think that efforts to standardize what can be standardized can in fact then encourage and stimulate innovation where innovation ought to happen. If you will, one could make a distinction between what we might call sort of foundational infrastructure, where the public goods in a market are provided, and then, I don't know, a more private layer of infrastructure where different infrastructure providers can compete and can compete on quality, but they're competing on a layer of foundational infrastructure that provides these public goods, good legal title, good governance, good functional independence, good regulation, and the like. I think those two support each other as long as we can parse them properly and focus collective attention on that foundational layer, and then let different providers compete on the more sort of private commercial layer.
So ensuring we have a trusted high integrity base and then allowing competition for
Much
hopefully
better.
better quality.
Yes.
Thank you. Thank you. That's really interesting. And I'm sure we'll have more questions on that. But Andrea, coming to you, the lack of transparency is most problematic today, right? I mean, trust is something that we've been struggling with. Who gets the money? Where does the money go? What's the benefit? How is the value? Which is in pricing and fees and in revenue sharing. So would love to hear your thought about how you're finding or how did the group find this buyer confidence, but also then how do we flip it to say, how do you build that transparency to create that trust without it becoming completely burdensome and becoming, impossible to manage?
Yeah, $1 million question, right? So to try and tackle this, we split the conversation into two sort of subgroups, fee structures and then revenue and benefit sharing. And we tackled each of those separately. I suppose the listeners should know that we had about 8, I don't know, maybe it was less, Michaela could remind us, but working group meetings of a number of hours each. So we did have a lot of time to discuss this in a lot of depth, which it really needed. On the fee structure, it was actually really interesting, and I'll probably worth starting off by saying what the problem isn't, rather than what it is. So what it isn't is a concern that crediting programs are not transparent with their fee structure. And sorry, I should also say we didn't only look at crediting programs, we also looked at VBB fee structure, but decided quite quickly we wouldn't go into too much depth on that because there's going to be another CIWP on VBBs in particular. So we focused a little bit more on crediting programs. And everyone concurred that it was very easy to find information about crediting program fee structures. It was, it's visible, it's transparent on the website. And actually, in itself, the structure of fees in a crediting program is not a barrier to scale. So what is then the question around sort of transparency that could be improved or could be worked on? Where we landed up is that it is actually very difficult to compare, or it can be very difficult to compare the fee structure from one crediting program to another one, to another one, to another one. Because rightfully, they are competing, and so the way they structure their fees are going to differ. What they call things is going to differ. But that doesn't make comparability of pricing easy. It actually makes it quite difficult. So although not a major barrier, not a major hurdle, it was seen that this could be an improvement, that it was somehow easier to compare one set of pricing to another. And so you'll see in the recommendations, there is a recommendation that a sort of standardized terminology is used, and where prices are sort of bundled together, they unbundled so that it makes it easier to understand what's included in one price and easier to compare it. So that was sort of one of the recommendations, and that the ICVCM developed some kind of library of where that information can be easily accessed. We didn't go into detail of what that library looks like, but that was one of the suggestions. The other thing that was discussed with regards to crediting program is whether there is a conflict or perceived conflict of interest, that fees which are based primarily on or linked to volume and the issuance of credits, whether that can be perceived as a conflict of interest and is a conflict of interest. So this was an important discussion, actually, a really important discussion. And the view was that it certainly could create a conflict, but that was already being addressed through the ICBCM's program to assess crediting programs. And as part of that assessment, conflict of interest is one of the aspects that are looked at. And so there was a view that, in fact, the governance of conflict of interest is already being well addressed by the ICBCM. It was also noted that, to your question on innovation you were asking earlier, there are newer crediting programs who have evolved the way that they, what their fee structures are and don't link it to issuance. So there has been also innovation in the market. It may be worth also just saying before I move on to benefit revenue and benefit sharing, again, in terms of what this discussion wasn't about, and the group was clear on this is not about the actual what the crediting programs are charging. Everyone recognized that in order to function efficiently and effectively, crediting programs need to be remunerated for their services effectively. And it's really, really important that they're able to do their job of ongoing continuous improvement on methodologies, and that requires, a significant amount of funds to do that. So it was in no means sort of questioning or, or concern about the fees that are being raised. On the revenue and benefit sharing side, the sort of key concern went towards two areas, the imbalance of power being the first one. So recognizing that there could be an imbalance of power where local communities are concerned, and how do you guard against that? What sort of things do you need to do? And that led to a discussion about what kind of transparency, what level of disclosure was required. And that was quite interesting because, again, that sort of deepened us into a definitional discussion that actually when we're talking about the need for disclosure of information here, we need to separate out the information that's disclosed for contractual purposes versus the information that's disclosed for the public benefit, when you're talking about transparency for public benefit. And those are very separate. Both are actually are required, but the kind of information provided is very different. And for contractual information, a lot of very confidentially sensitive information needs to be discussed, which of course would never go out into the public domain. So that was a sort of important definitional understanding. And where we got to with recommendation is that it is very important for counterparties to ensure that through access to information, understanding of information, there is no imbalance of power, and that in terms of discussing benefits and equitable benefit sharing, a really important principle that we got to was that benefit is in the eyes of the beneficiary. So, and that was because it was quite a big question about, is benefit sharing just about the income from the sale of credits, or can benefit sharing also be about a dam that's built, fees that are paid for jobs that are created, like where does it begin or end? And that's where we came to, it's really in the eye of the person receiving the benefit. And if they believe that that is equitable because of it being a benefit of the project versus a share of proceeds, then that's fair, that's okay. So that was a really interesting discussion. I think I'll pause it there, Kavita.
Thank you, Andreas. I love it. I love the last point especially, and I think it is also about giving people agency. And it's allowing people to think for themselves and decide for themselves rather than just saying, here's what we think is best for you. So I think there's a lot to unpick there. But besides, what do the investors want? My God, if you start looking at the investor perspective, what do you think is really the biggest barrier? Like, why are we not seeing this investors? And if we replicate everything that, they do, or the structures or the instruments that they have, will we actually get that investment, or are there some things that are so critical that we can focus on some real key points.
Thank you. Thank you, Kavita. The single biggest barrier that we discussed in the group is the absence of kind of finance grade legal and financial classification for carbon credits. That is like the fact that the carbon credits are not treated as recognized on balance sheet assets under any major accounting or legal framework that is kind of foundational, basically. Every other constraint, like pricing opacity, risk uncertainty, the lack of standardized metrics, ultimately traces back to this gap. The institutional kind of investors operate within strict mandates governed by their kind of legal, fiduciary, accounting obligations. When an asset class lacks a clear legal status, cannot be carried on a balance sheet, and does not fit within the established risk frameworks, it is effectively invisible to most institutional capital, regardless of the underlying merit. So the report itself captures this directly. It clearly states that the carbon credits are not currently treated as on-balance sheet assets, which prevents their use in structured finance or as collateral, and that uncertainty around the legal, financial, and risk characteristics of carbon credits limits the engagement from mainstream financial kind of institutions. Without resolving this classification kind of question, the instruments like securitization, collateralization, or forward contracting remain inaccessible in practice. A secondary but kind of closely related barrier that the group has focused on was the lack of finance grade assurance. The institutional investors require trusted, auditable data to price and finance these assets at scale. The carbon markets currently lack consistent assurance systems comparable to what exists in traditional kind of financial markets, which means kind of the investors have no reliable basis for valuation or kind of risk modeling. So that was these two were seen like the biggest barriers for institutional investors.
I get to go off mute. There's so much commonality that is coming across the groups. I mean, Chris started off with talking about legal status right up front, and then Visak, you got to that. We have a number of questions coming through, and I'll turn to that. But I think maybe just start with a broad question that is underlying what we're all doing, and like, how much trust does the market need? Like, are we being held to an absolutely impossible standard? And will all of these things actually address the core requirement of trust? And I'm happy for anyone to pitch in, because this is not technical, but more of the, is this good enough? And will this actually shift the trust equation and the investment into the market?
I'm happy to take a first crack at that very important question, which I saw in the chat. I think I agree with the sentiment that it is that we should acknowledge that this market is easy to criticize by invoking mistrust, even if that criticism is insincere and disingenuous. That said, we need to make sure that we do engender sufficient trust, although it's hard to know how much trust is enough trust. The way I think about it is that the market needs at least enough trust and integrity to be able to not eliminate the possibility of any shock or trauma or scandal, but rather to survive a scandal or a shock of one kind or another. A quarter of a century ago, the U.S. electricity market, power trading market, suffered a scandal of titanic proportions in the form of the Enron scandal and the failure of Enron. And I think that there are two lessons to learn from that, or three perhaps. One, the power trading market did not collapse and go away as a result. It survived. Number two, we remember that Enron disappeared, but we often forget that Arthur Andersen, their auditors, also disappeared as a result because the third-party assurance, that element of trust was called into question, and those providing that assurance lost their job and their business as a result. And as a result of that, U.S. regulation and oversight was improved with the creation of the Public Company Accounting Oversight Board. So, it would have been much better to have avoided Enron altogether, but we did learn that that market at least was robust enough to be able to survive that, and there was the capacity to learn from those lessons and to make improvements in governance. And I think that's where we want this market to get to. I don't know how close or how far away we are. That's impossible to say. But for me, that's in a sense a practical litmus test for how much trust we need.
Thank you, Chris. And I think this is, partly why, I mean, this is exactly why CCPs and ICVCM exist. But I think we're going beyond that. And I think, Basak, this the question, but also just a follow-up from that is like, we can adapt to whatever the financial sector, all its frameworks and assessments and management practices and insurance and things. But do we actually feel like that will get us the scale that we need and increase the interest? Or is it just that, the market is not being seen as sufficiently rewarding, like it's not giving the return on investments? Like, are there other issues that we need to deal with, or where do we even start by engaging these institutional investors and other investors?
I think it was Churchill who said, "Never waste a good crisis." What was it? Never let a good crisis to go to waste, or something. Like we had our own crisis, obviously, as the carbon markets. But I think we took lessons. Like there are more eyes on the market at the moment. There are, the ICVCM, the CCP, the CCP. So the market has improved massively, I would say, in the past 3 years, in terms of trust, in terms of transparency and so on. But again, for me, like at least for institutional investors, that is not enough. Trust is not enough. I like the Chris's quote, how much trust is enough trust. It's not enough because you really need, I mean, this, as I mentioned, the institutional investors operate in a very kind of strict frameworks. They have their fiduciary duties, legal duties, accounting duties. So if we can't fit in to that kind of framework, we won't be able to attract massive capital from institutional investors.
And so is it less about the trust and more about just a return on the investment and, managing risk, and all the other things that come with it? I mean, we know that even with the best of intentions, there are a lot of risks. There's pricing risk, there's market risk, there's regulatory risk, there's political risk, there's, we live in a world of complete uncertainty. And so is it truly about, showing where the money is?
I wouldn't think so. I mean, like obviously, for an investor, it's always a question of return, and there is no doubt about that. But it's also very important to define the product. So at the moment, as I said, if we can't fit the product within the investable kind of product frame, then it's very hard for an institutional investor, even if they have an appetite, even if the rate of return is very good, let's say. If they can't like say, okay, this fits, this I can put it on the balance sheet, it has an assurance that I can have an auditable data and so on, then it's very hard for them to pass their kind of investment committees. So I would say, even the rate of return is very important, but it's not enough at the moment. And I don't think the carbon markets have a lower rate of return than other kind of energy markets or other, I mean, maybe not oil, but like other type of markets. but I think like, if we can, as I said, like, ensure the legal definition or kind of financial definition and make sure that it fits within like the product frame of the institutional investors, I think we would have a good chance.
Yeah, worth a try because we really
Yeah.
need to unlock that capital. But Andrea, you've been, I mean, transparency and disclosure is a lot of it is follow the money, like you've been talking about,
Yeah.
the fees and the pricing structures and benefit sharing. But I think you made a really interesting point, which was like sometimes it's not an issue of transparency. Like, the information can be got, but we cannot always compare it or understand it or, put it into kind of like the most actionable data that there is. Can you give us some example of like where you feel like that transparency is there, but we still feel like it's lacking and it just surprised you? I mean, you mentioned one, but it'd be interesting to see if there's more.
Yeah, I mean, I think broadly we forget that this is quite a nascent market and we are building it. So we do have a lot of information, have a look at crediting programs, have a look at the methodologies, have a look at the reports that are produced. But is it always easy to access? Is it standardized? Is it accessible through central places? Is there data interoperability? These things are not necessarily easy to get it yet, but it doesn't mean that there isn't a huge amount of information out there. So I think it is a case of these building blocks, and in some cases we've through the sort of cross questioning of the integrity, we've ended up going a little bit backwards. And I think one of the areas where we're doing that is on the use case for carbon credits. And if you want investors to invest in this market and generate a fair return, there's got to be there needs to be demand for credits. And right now, we keep going round and round on this debate about how do companies use credits? How can credits count? What is the business case for the use of credits? And in fact, I'm just was in Barcelona last week for the European Climate Summit, and we held a discussion on safe harbor. How do companies get protection from regulation so that they can make claims about how they're using credits, a safe, and there is safe harbor regulation to protect them. So there are these gaps still that are actually really, really important and do exist in other markets. It's not as if they don't exist. Another piece which I think is still missing is we have no self-policing of our own market. We have no ombudsman. We have no complaints and redress mechanism. So we need to actually be not only self-governing our industry, but also self-policing it and doing something about investigating these issues ourselves and having transparent disclosure of where participants in the market are not performing up to our industry standards. So I think there are some really, really good things, but there are still things that we are working on. And I think until we've resolved all of them, there still will be questions.
Yeah. So many, you've opened so many little threads that I would love to follow, but I'm not going to. We're going to run out of time. But
To
I
some
do love the
extent,
idea of
Kavita, I think your question really points to the value of what was analyzed in the report, because so many of those critical building blocks are what we attempted to look at. But as a former market regulator, I'd say we always used to say that market confidence, when it's lost, is very difficult to regain.
Yeah.
And in our case, as you know, this market has been, largely unregulated. There certainly were issues, and I think this focus on the building blocks of how to make it a high integrity market. We started with the CCPs, but as we said, that's not the end game. That means the underlying credit has integrity, but what about the market on which it trades? What about the transparency? All these things that we've talked about today. But I think the question also raises the issue just about, and we've talked about this many times, about the narrative around carbon credits. We need to be forward looking. There have been problems in the past, and there's no point in denying that. But understanding that there is a very critical effort now to address those issues and to have carbon credits be considered a high integrity, tradable asset like others. And that's exactly what we're focused on. So we shouldn't be sort of, I know there'll always be the naysayers who don't like credits, but the fact of the matter is that there's a huge amount of effort here. And I think some of the additional points, like what Andrea raises about, ensuring that we have oversight of the integrity of these other functions, all these things are very valuable, but I think we're on the right path. And I'm hoping that even this report is a real step forward in a recognition of what, in addition, has to be done to get us, to the level that we want to be in terms of a high integrity, liquid, transparent market.
Which has high demand. But thank you for that, Annette. And I would encourage everyone to read the report because a lot of these issues have been touched upon, and they're very concrete recommendations coming from that, which everyone in the market needs to work on. I mean, it's for all the market players to help make this much more high integrity with the right rails, with the interoperability, with everyone getting benefits and getting more institutional capital. So really encourage everyone to read the report. And thank you to the panel, not just for being here today, but for leading and really bringing insight and convening the discussions on the CIWP. And Annette, I'm going to hand back to you to close us out in the last 2 minutes.
Well, thank you so much. And I will be brief. As you said, we do commend the report to those of you who are watching today. The link was in the chat, but obviously you can look on the ICVCM website as well to get that information. And as we said earlier, the report is really just a starting point. It's not an end point. We're taking forward a number of the recommendations through our ongoing work streams, particularly in areas such as registry infrastructure, interoperability, market transparency, and data integrity, and the role of financial frameworks in scaling the market. But this work will also feed into our continued evolution of our assessment framework and the guidance that we provide to the market more broadly. I also want to mention to everyone on the call today that there are several ways to stay engaged as this work progresses. Our market consultation group, which many of you have probably dialed into before, will continue to serve as a key platform for targeted input and feedback. And we're also going to be launching consultations and pilot efforts to test some of these recommendations in practice. And we really welcome a continued dialogue with all of you and your organizations as we move to the next phase. I know Chris emphasized that one of the strengths of the Integrity Council is our transparency and openness to feedback, and that we're very serious about getting that feedback from you. So ultimately, the message here is very clear. The carbon market, as we said before, has made meaningful progress, but it can't scale unless we have integrity, and we have to continue to strengthen the systems as well on which the market operates. Before we close, I want to make two very quick points. One is, if you'd stay on for a minute longer, we're going to have a short 5-question survey that will appear on your screen as the webinar ends, and we'd really appreciate your feedback so that we can use that to improve our future sessions. And secondly, we hope you'll join us for the next webinar in the series, which is going to be the Wednesday, May 6th. It's going to focus on our CIWP 12. These things have numbers that mean nothing to anybody but us, but that's the one on exploring transition crediting as a way to support the early retirement of fossil fuel assets and accelerate the shift to clean energy while maintaining high integrity carbon market principles. So we'll share details with you on how to join the webinar later, but if you want to calendar it now so that you don't have a conflict, I think that'd be great too. So again, I really want to thank our co-chairs on this effort. You did a magnificent job. I want to thank everyone who participated. We had a very broad cross-section. We didn't get to name you all today, but we very much appreciate what you did, and thank you for your contributions and for your continued support. And with that, we'll close, and I hope you all have a very nice day. Thank you.
Thank you so much. Bye.
Thank you.
Thank
Bye,
you.
everyone.
Bye now.